Sir,
Yeah, tell me.
so 12 marker in section D will have only one question from retirement.
Yeah, only one. Now earlier admission or retirement, anyone. Now in this paper, what I have shared with you, model, possible that both admission and retirement will be there in that.
Okay, sir.
I'll discuss that separately. Model question paper, I'll discuss with you separately.
Yes, sir.
Page 52, problem number 2, 12-mark question under retirement. Radha, Sheila and Meena were partners in a partnership, sharing profits and losses in the proportion of 3:2:1. On 1st April 2018, Sheila retires from the firm, and on that date, balance sheet was as follows. Remember, usually for you purpose in the examination, you will find the retirement happening at the end of a year or beginning of a year. You don't get mid of a year. Somewhere in the middle of the year, you don't get it. So easy to work. So balance sheet is given, cash in hand, cash at bank, debtors, stock, factory premises, machinery and loose tools. Liability side, you have trade creditors, bills payable, expenses owing. Owing is nothing but outstanding, payable. Outstanding expenses payable. So liability. General reserve and three partners capital. So remember who is retiring? Sheila is retiring. From the beginning, if you see, Sheila is the second partner. This is very much important for you to find out first, because the profit sharing ratio also we have to take accordingly. So Sheila is the second partner. For Sheila, it is 2/6 will be the profit share. So second profit loss sharing proportion will be applicable to Sheila. This is very important for you to ascertain whether the partner is the first one, second one, or the last one. Very important to know. Coming to the terms therein of the retirement, goodwill of the firm, underline the word firm, was valued at 13,500 and written off to be closed. Goodwill account has to be closed. Expenses owing to be brought down to 3750. Outstanding expenses to be reduced to, underline the word to. To means we have to take a difference amount. Next, machinery and loose tools were to be valued at 10% less than their book value. Next, factory premises are to be revalued at 24,300. So, first adjustment is related to capital accounts. B, C, and D connected to revaluation account. So, prepare revaluation account, partners capital accounts, and a balance sheet of the firm after retirement of Sheila. That is, after Sheila retires, what will be the revised balance sheet that we have to work. So most of it is same. Where it is different from the admission of a partner, I'll explain to you. So let me first get into the working part of it. Page number 52, as I discussed with you, and problem number 2, 12-mark question in the question booklet. So I have the pro forma ready with me for revaluation account. As usual, as we did in the admission of a partner, absolutely no difference. So first adjustment, goodwill will not come here. Second one will come, expenses owing to be brought down to, that is reduced to 3750. I told you to underline the word to. To means it is difference amount. So here you find in the balance sheet 4,500 is the expenses owing in the balance sheet. Now it is 3,750. So liability reduced. Liability reduced is a gain. Remember, decrease in liability to be taken on the credit side of revaluation account by expenses owing account, $4,500 earlier. Now it is 3,750. Difference of 750 is a gain for the business. Next, machinery and loose tools are to be valued at 10% less than their book value. Both are assets. We have to take separately, machinery separate and loose tools separate, 10% less. So it is a loss. Decrease in asset is a loss to be taken on the debit side.
Debit side.
To machinery account, machinery value is 8,000 into 10 by 100, 800. Next, to loose tools account, the value of the loose tool is 4,000 into 10 by 100, 400. You can check once again, 10% less than the book value. Machinery is 8,000, loose tools is 4,000. So 800 and 4,000. Next, factory premises are to be revalued at 24,300. So 24,300 is the new value. Let us see the old value, 22,500. So old value is less, new value is more. So asset value has increased. So asset value increase is a gain for the business, credit side. By factory premises account, new value 24,300, old value that is in the balance sheet 22,500. The difference amount
1,800.
1,800 to be credited. So we have considered B, C, and D. All the three are done. A will come in the capital accounts. So let me go for balancing this account. Credit side is more, as you can see. Check the totals properly. $2,550. Take it to the debit side. Minus 1,200.
1,350.
Very good. 1,350. So this is balance amount as earlier. Revaluation profit because credit is more, debit is less. To partners capital accounts, first partner Radha, 1,350 into 3 by 6.
675.
675. Next, Sheila, 2 by 6.
450.
Okay, good. Third partner also, all the partners, remember, will get it because all are old partners only in a way.
$225.
Good. So you can verify again. Adding these three amounts, you have to get 1350. Very important. Then only your answer is right. You have to check at every level. If you don't check, if you go further, if there is a mistake, entire problem will go wrong. You will not know where you have committed a mistake in the exam. So you have to check at every level. Coming to the next one. That is goodwill. Read the sentence carefully in the problem. Goodwill of the firm was valued at 13,500 and written off. Of the firm, underline the firm. Firm means all the three partners. Together it is 13,500. So when goodwill amount is valued in the books of the firm, the situation, remember we are doing as per accounting standard number 26, we are doing given in the problem. Goodwill of the firm is valued at 13,500. Retiring partner Sheila's share of goodwill is 13,500 into 2/6. So remember, I told earlier, Sheila is a second partner. So her share is 2. 3 is to 2 is to 1. So second position. So 2/6. So 4,500 rupees. So this 4,500 rupees to be given to the continuing partners, that is Radha's capital account data. Next person is Meena's capital account data. So what is the one? Remember, 4,500 to be divided among continuing or remaining partners in their gain ratio. So what is the gain ratio here? How to find? Nothing is given. We will cancel 2. So if Sheila goes out, 2 is gone, remaining is 3 is to 1. So that itself will be the ratio. Gain ratio will be that only. So that amount 4,500 to be divided in 3:1. Three by 4. Check the amount once. One one two five for Meena. So to Sheila's account, full amount 4,500. I'll just make an entry. Wait for a second. Being goodwill valued to the extent of Sheila's share and written off. So this you have to remember, this is the only one type of goodwill you will get in retirement. So you don't get any other method. This is the only method. Earlier there was 6 different methods, only one method now. So we'll go for combined partners capital account now. So same like earlier. First we have to go for finding out the capitals of all the 3 partners. If you see here, all 15,000 each. On the liabilities side, so all our credit balance only. Second step is looking for general reserve or reserve fund. We have one here, reserve fund 13,500. So this 13,500 to be divided among the partners in 3:2:1 ratio. check once the values are right or wrong before you proceed further. If you add all the three, it should be 13,500 only. Then we have to search for any P&L account. We don't have a P&L account here. Third step is gone. The fourth step is revaluation profit or loss. In revaluation account, we have as two partners capital accounts. So it becomes by revaluation account. Is a revaluation profit. Like earlier, we have to take that also. So 4 steps are completed. Now the goodwill treatment. After revaluation, goodwill treatment, remember, you can see here entry, Radha's capital account data, Meena's capital account data to Sheila's capital account. So this amounts to be taken in Sheila, that is in a way, Radha is giving to Sheila. One second. Next, Meena's account is 1125. Remember who is retiring, their account is credited. Remember Sheila's account credit here. So one side of the entry. So remember goodwill will come both the sides. We have done this in the admission of a partner also. To Sheila's capital account. Radha is giving to Sheila 3375 and Meena is giving to Sheila 1125. So goodwill entry will come on both the sides. So till here, it is the same like the admission, no change at all. Only one thing you don't find is that new partner bringing in capital will not be there. So that entry is not there. Instead of that, one more extra entry will come. In place of it, you'll come to know that. This is the first thing. So we have to enter all these things. First is capital, reserves, then if any P&L, then revaluation profit or loss, then the goodwill treatment. As I told, only one method for you at present. So now, who is retiring, only that partner's account has to be closed. Do you find anything in the problem given here that how the payment to be done to Sheila? So if you look at the terms, nothing is specified. That means no payment is done to Sheila at present as per the problem. So I will tell you what is to be done for it. First, always balance or total the retiring partner's capital only. $24,450. Yeah, perfect. So this amount, you take it to the debit side. And now Sheila is not being paid. So we have to balance Sheila's account and we have to transfer the balance to Sheila's loan account. Sheila is no more a partner, remember? No more a partner and nothing is paid to her. Nothing is paid to her. So that amount goes to loan account. Now we have to go for balancing the remaining partners' capital accounts. Whichever seed is higher, we have to check. Credit is only more.
$475.
Yeah, okay, done. Good. So take that to the debit side. The continuing partners capital accounts value. See how I am doing. Carefully you have to do. Now balance only Radha's account. Radha is a continuing partner. 22,425 minus 3,375. The balance we have to find.
$19050.
So this is going to be the closing balance carried down. Remember, closing balance carried down for the continuing partner. Similarly, 17,475 minus 1,125 we have to do
16,350.
16,350. Very good. So now only two partners are left. So that becomes opening balance of two partners. Remember, Sheila is no more a partner. Never forget. Whoever is the continuing partner, you have to remember carefully. It may be a first partner, second partner, or whatever it is possible. The next account is the loan account of partner. Only you can see here to Sheila's loan account. It becomes here by Sheila's capital account 24,450. Nothing to enter further because no payment is done, nothing. Just leave it as it is. Don't worry further. Not even compulsory. Just to practice it is required. Then new balance sheet. On 1/4/2018, we have to revise the balance sheet now. Asset side, cash in hand, cash at bank remains same. No adjustment is there. No change. 1,500 and 7,500. Same value you can see 1,500 and 7,500. Next is debtors and stock. No change, no adjustment for debtors and stock. Debtors 15,000. Stock 12,000. You can check out debtors and stock 15,000 and 12,000, no change. Next, factory premises. We have an adjustment. Remember, revaluation account you check. Factory premises increased by 1,800. It is increased. So add appreciation. Now, 1 second, please. To continue further, machinery 8,000. So machinery, there is a reduction of 10%. depreciation 800, it becomes 7,200. After machinery, we have loose tools. Loose tool also decreased by 10%. $3,200. Next, liabilities side, creditors remain same, bills payable remains same. Trade creditors 3,000. Bills payable remains same 4,500. Next is expenses payable, expenses owing 4,500 less reduced 750 3750. Then capitals of two partners, Radha and Meena. Before that, we have to put Sheila's loan account. We have to check the amount here. Sheila's loan account is 24,450 and capital amounts are Radha 1950 and